Hi, good afternoon, Hansi, Amar, and Ashish. Uh, just received a message from Shobit. He's running late by 10 minutes. So I believe we should just wait for him to join in and then start the session. So audience, good evening and welcome to the Real Estate Investment Innovation segment of IPI 22. We're waiting for one of our other panelists, and we plan to start this session in by 4:25 or 4:30 max. So just hang on and we'll start it as soon as Shobit joins in. Yeah, I believe Shobit has joined in. Welcome, Shobit, Amar, Ashish, Hansi. Request you to please put your videos on. Hi, good evening, Amar.
Hi, good evening.
Hey, hi.
Hi, hello everyone.
Hi. So great. You were just late by 5 minutes. That's okay. Hey, hi, Ashish.
Hi everyone. Hi Aditya, Shobit, Amar. Good to see you guys. Hi Hansi.
Hi.
Great. Guys, so thank you so much for joining in. I welcome all of you to this very exciting and initiative that we put together this year. We believe something like this was long in the making, and a platform like this, which annually can bring together exciting investment opportunities on one platform. I'm sure in the years to come, it will be taken very, very seriously, and more people will join and benefit from it. So before we start, I'll quickly give you all a background to the entire initiative. As you all are aware, this entire initiative we've set up for two set of audience. One is the wealth advisors who are looking for new product to offer to their investors and clients, and the other set is the investors themselves who are increasingly getting experimental and who like now diversifying their investment to various asset classes, not just mutual funds, equity, or ETFs. So this entire initiative, we've set it up as a annual platform spread over 10 days, where each day we are focusing on one asset class. And idea is to bring together some thought leaders from the industry to talk about exciting and innovative things happening in that particular segment, and also showcase some interesting opportunities for the audience and and the distributor community. So today is the real estate part of it, and all of you are stalwarts from the industry. So it gives me great, a lot of happiness to invite some old friends and some new to this opening panel discussion. So audience, we have with us today a good friend Hansi, who's the editor of Money Management India. He'll be moderating the panel. Welcome, Hansi, and thank you for joining, taking the efforts to structure this entire panel discussion. Our first panelist is Mr. Amar Mirani. Amar heads the real estate investments at IIFL Asset Management. Welcome, Amar. Thank you for your time. A second panelist is Mr. Shobit Agarwal, again an old friend and MD and CEO of Anrock Capital. They don't really need an introduction. They've been all around as far as real estate investments is concerned. So can't wait to hear more from Shobit on what's new happening at his end. And third and final panelist is Ashish Kandelia, of someone whom I met recently, but I've heard a lot of rave reviews about him from some of the industry friends, and another hotshot entrepreneur who's trying to do something exciting in the real estate investment tech space. So we have a very interesting mix of panelists here today, and we can't wait to hear your views on what's the new and exciting things that you are keeping you guys charged up about real estate investments. So Hansi, without further ado, I'll request you to take over. Also, before you start, let me tell the speakers that all the speakers have joined us on Zoom. The audience has joined us through a separate virtual event platform. So I will be back towards the end of the panel discussion if we have some time left to facilitate some Q&A for you guys. On that note, Hansi, over to you.
Right. Thank you, Aditya, and very good to meet you, Ashish and Amar. Hi again, Shobit. How are you doing? So we could not start without you. Okay, there's just no way
Thank
we
you.
start without consultants. Okay, I was one. I know you are one. So
Thank you.
and I
Apologies, I was out of town, so
no problem, no
jumping
problem.
meetings.
You have some very
But yeah,
interesting window at the back, but we shall keep that for after the session. I hope you're not dialing in from a holiday. But
no, no,
let's
no,
get
no.
started. Let's get started. So as I sort of said, my background is consulting more on the institutional pension funds and overall. But you come from a consulting side specifically on real estate, first JLL and now with Anarok. So let me start with, I guess, the very big picture, which is basically over the last 15 odd years that I've been coming to India, I've seen a transformation in terms of how people view real estate. Gone are the days where
Mm.
people only buy an apartment, maybe a shop, maybe a strata office. That was the extent to which reasonably well off, middle class and reasonably well off people bought real estate. Now I see many, many more things being discussed. So maybe perhaps you could give us a very big picture overview of how Indians have sort of change the way they invest in real estate and what all is available to them?
Very interesting question. I didn't see this coming, but you're right. From almost 17, 18 years ago to today, the landscape has completely changed. And the trigger for this was the FDI policy being announced in 2005 under, at the end of UPA 1, which allowed dollar denominated money to come in and start getting invested in what we would call as institutionalization of Indian real estate. It's been close to 17 years since the first dollar really came in. And over so many years now, almost 2 decades, uh, plenty of money, I would say about $35 billion above, has come in. And what it has done is started to build out in a small way and then eventually scale it to a large number, build out very good quality offices, warehouse, retail malls, etc. Right, especially the yielding sides of real estate, and then even gravitated that to the Indian stock market. That means you now no need to buy. You don't for a HNI, the middle class, in the upper middle class. You don't need to buy physical real estate. You can just buy a piece of it by participating in the list co or the REIT co, which is already listed. So from all the trouble of buying it, managing it, and then leasing it and selling it, right? All that has gone out of window because now you can simply on a click of button buy institutional quality real estate to whatever pocket it allows. So it means I think $300 a piece to whatever else you like. So you can invest as little as $300 and as much as you like. So that's completely changed the way we think and consume real estate for investment purposes. Over and above, in the last 5 decades, 5 years, and especially during COVID, I think people adopted digital quite quickly. So we've got now digital platforms set up for fractionalizing Indian real estate. This includes fractional ownership of yielding assets, fractional ownership of loans, and Ashish is better place to talk about it. So several opportunities. It's not the grandpa thing saying go to the market, talk to a broker, buy a piece of real estate, right? Hunt, lease. So all that trouble is out, right? And fortunately, unfortunately, nobody is investing in residential anymore. I think people are using it or buying it only for self consumption. As a result, even that asset class has matured a lot in terms of both quality and moderation of quantity. I won't say that quantity is over the roof. So I think we're starting to build as much as we want to eat or consume. So we're not running faster than demand. So I think that's a great thing. So both resi and yielding play, I think, are getting balanced out, and we are just seeing a beginning of upcycle after a very long, slow correction uh, during which all these changes happened. So I think in future you'll see more digitization, more digital play, more listed play, and so on and so forth. So I think it's changed forever. I mean, this change is going to stay. That's all I wanted to say. So, Hansi,
Great.
back to you.
Thanks, Robit. So there's a bunch of things that you mentioned there. One is obviously the overseas money coming in. So they are the more institutional investors because there's a dearth of domestic institutional investors, I guess. So that's one. The financialization, as you said, is another theme that is playing out. And with both of these, I guess, comes the standardization of jargon, of nomenclature. So in terms of when you say grade A, it's rare that I've actually seen it in the literature in terms of defining real estate in terms of grade A, grade B, grade C, or retail and even also on the risk spectrum from core plus, opportunistic, value add, and so on. So I think hopefully that will happen.
That's right.
With that background, let me sort of switch to Amar. You represent a group, IFL Wealth, which has sort of the wealth side representing HNI investors as well as on the asset management side that you represent. What sort of themes are you seeing playing out in terms of what investors are asking for and what the supply or the intermediation of real estate is allowing people to offer in terms of supply?
Yeah, thank you, Hansi. Good to be here. So I'll just take on from what Shobit has said and quite relevant themes that were put out. So if we look at where we are and where we started out from in 2000, let's say 3 onwards, when the overall markets and the overall economy and emerging markets started moving up, real estate opened just a couple of years later, and we saw a huge amount of liquidity coming into the country, which helped generate jobs, which helped generate a lot of interest around real estate as Press Note 2 came in 2005. And then onwards, we have seen the sector getting organized a bit more, quite a bit more, better governance, better practices, better quality assets, and range of offerings on the financial side, which make it far more sophisticated as compared to where it was 15, 20 years back. So let's say if I would talk about 2002, which is 20 years back, a 50 crore loan to a developer would have looked amazing. Wow. Today, nobody even cares about it. So in the last 20 years, and that also would have been to the absolute top grade developers, maybe 2 to 3 in every city. 1 or 2 banks will be doing it apart from HDFC Limited. That's it. So in the last 20 years, we have not just seen loans expanding hugely. We've seen it coming from HFCs and NBFCs and funds now. We have seen REITs, we have seen InvITs, we have seen mezzanine structures, we have seen cash flow, first charge, second charge structures, we have seen distressed funding, inventory funding, pre-approval funding, post-approval funding, everything. And it's not much, it's what, 18 years since all this started. So which makes us feel that this is only the beginning. There's a far bigger play on real estate that is expected in the next 5 years, leave alone the next 10 years, but even the next 5 years, because of the following reasons. Number one, we are far more organized, matured, and much stronger hands, both in terms of developers and finance providers, compared to where it was pre-2018 because of the NBFC crisis and all whatever happened. So it's much stronger and more capable and bigger hands. Number two, the practices that developers and financiers used to employ earlier have changed significantly. Far more mature, calibrated, aware of the risks, aware of the returns, aware of the bounds, and the potential upsides and downsides. The unbridled greed or fear is not much there any longer, and therefore it's far more mature from that perspective also. Third, as far as foreign capital is concerned, we are still pretty small in the overall context. We get somewhere between 5 to 6 billion a year, and we seem to be happy with it. But in the overall context, it's extremely low. Every year you have about $1.1 to $1.2 trillion of money coming into real estate globally, of which we get 5 to 6 billion, which is not even 0.5%. For a country like India to get 0.5% is minuscule. we need much more, we deserve much more, and I'm sure we'll get much more given that 1 and 2 have happened. So all I'm trying to say is that there is grounds for a significant increase in the potential of money flow into this sector, and not just from international sources, but even domestic sources. Because if you look at it from the domestic segment, options that wealthy investors and all classes of investors have, apart from the capital markets, there is real estate. There is, of course, non-real estate credit and private equity. Now, each of these segments has seen a fair bit of activity in the last few years. If you look at the stock markets, if you look at how they've increased in the entire COVID period, doubled more or less and then come down a bit. Private equity valuations, where they are, seem to be a bit under a spot of bother. Whether it gets more money from here incrementally in the same pace as what it got in the last few years, doubtful. Credit seems to be good, interesting. Both real estate as well as non-real estate seems interesting. But on the whole, if you look at it, real estate has not seen this kind of interest and momentum as what we are seeing now after a long period of time. We've had a lot of industry defining events like RERA, GST, demonetization 2016, NBFC crisis, and then COVID. And now finally we are up and running. Developers and financiers know what we want from each other, and number of people who provide capital as well as number of people who are availing of capital are limited, and therefore the degree of understanding each other is much higher at this point in time. If you come to the present juncture as to where we stand today, and then we'll come to the kind of investor interest and appetite. At the present juncture, look at each of the aspects from a developer point of view and compare it with the last 1.5 years. If you look at sales, developers enjoyed a purple patch, fantastic time in the last year and a half, where there was a huge amount of pent-up demand, low interest rates, wealth effect, a lot of fence sitters earlier who did not buy, and therefore we saw a lot of sales in many cities across segments. Highest ticket to the mid-range market, there were a good amount of sales in residential. So therefore selling was easy. Now, because interest rates, we saw today interest rates have gone up again, 1.4% increase in the last 4 months, and wealth effect wearing off a bit. Stock markets are where they are, precariously poised perhaps. And therefore it's not, the momentum doesn't look like sustaining at that level. It will be better obviously compared to pre-COVID, but still it's not the last 1 year of the burst of sales that we saw. So it will be challenging to sell going forward, especially if prices are increased. Second, if you look at construction, commodity prices having gone up, steel, cement, labor gone up. Therefore, will construction costs, margins, will it be easy from developers' point of view? Not so easy. Therefore, again, a challenge. Finance costs have gone up, number of lenders have come down, and therefore, even obtaining finance at the right terms will be a challenge. Therefore, developers will have to innovate. Technology will have to be used, whether it be whatever it is, could be VR, could be AR, could be IoT, could be 5G, could be many of these practices together, could be digital marketing. Everything will have to be done. Property technology will have to be harnessed. Many more facets of technology will have to be bundled together so that productivity goes up as well as costs are mitigated and customers are obtained at as easy terms as it was in the last 1 to 2 years. So therefore, these challenges will have to be met by advancements in technology and better processes and governance, which we are on the way to do. As far as investor interest is concerned, definitely high, both in yielding assets, which is REITs, as well as in credit, which is funding to developers, provided, of course, it is good developers, leverage under control, approval risk significantly mitigated. There is enough and more interest now as compared to what it was earlier. In fact, a lot more than what I would have thought in the last 6 months back. So So that is what I would like to say at this point. And yeah, we look forward to doing far more in this market, in real estate, and hope to see that happening over the next 2 to 3 quarters.
Right. Okay. Thank you. Thanks, Amar. One thing that comes to mind, and again, having put my old Mercer hat on, other asset classes, I could still consider India, but real estate is one of those where the reputation of the prevalence of black money and the issues with land titles or not having clear titles and things like that that come to mind that may put off some overseas investors, I would have thought. But coming back to your question, sorry, you said 5-6 billion. I mean, how much do you expect? What do you think we deserve, and what do we need? Do we need foreign capital in real estate? We might need it in venture capital and a whole bunch of other asset classes, but why do we need foreign capital in real estate?
Oh, of course. See, foreign capital is not just from the money point of view, but also from the point of better processes, better technologies, because when capital comes from a responsible financial institution based, let's say, in the US or Japan or wherever it is, it comes with a huge amount of experience behind it of managing that capital with better processes and technology that need to be adopted by the deployer, by the developers over here. And therefore, it's not just money, but also a lot of other things associated with it. As far as the amount is concerned, 5 to 6 billion in a country of 135 crores, and urbanization increasing, and a huge middle class expanding across segments, office, warehousing, residential, and now data centers, hospitality, retail malls. It's too low. At 0.1% of the global capital coming to India, it's abysmally low. We need definitely far more, and with infrastructure development now taking place across many cities, metro programs coming up, and better connectivity to the outskirts of these cities, there will be a lot of development that takes place, which may not be amenable to just domestic capital, because the period, the tenor of capital is limited in the domestic segment as compared to the offshore segment, both for infra and for real estate. And therefore, both types of capital is needed, not just domestic capital. Therefore, there's a strong need for offshore and domestic. Yeah.
Right. Right. Thank you. Infrastructure, I totally understand. And I take your point about real estate as well. Some of these innovations that you mentioned, or some of these changes you've mentioned, both Shobit and you, in terms of, for example, REITs. REITs, I mean, I did my whole career in Australia, and REITs existed in Australia 30 years ago. So it had nothing to do with digitalization or necessarily an innovation. It's a very simple financialization and listing on the stock market. But let me turn to what has sort of truly transformed. Ashish, if I could turn to you, and you also, I looked you up, you have a background in KKR, so maybe sort of pick up on Amar's point as well in terms of what innovations are we seeing in the Indian market, both something that we have brought from overseas and more, and some that perhaps we have come up with just because we are at a point where the internet and just generally digitalization is there. We are as much as at the forefront as anyone else. So what are we seeing in terms of digital platforms or any other type of innovations in the Indian market today? You're on mute.
One sec, yeah. So, no, I think that's a very relevant point, and all this innovation, I think, is fairly new. In the West, it has been happening. And in the West, the financialization, as you yourself just mentioned, started 30, 40 years back. So whatever digital is doing is a new form of financialization, and making it a lot more accessible, making it a bit easier for many other people to understand. Like, while REIT and fractional ownership fundamentally is no different, you're fractionalizing asset. REITs are being able to fractionalize very high quality, very well managed assets. Fractional ownership less so, but easier to understand fractional ownership than REITs, right? So, I mean, I will just rewind a little bit based on what Amar was saying, and this whole contrast between foreign capital and domestic capital. And in fact, all my life, I've actually been with Morgan Stanley KKR, always deployed foreign capital. It is last 4 years since we started on our own. And at this point in time, we're as much dealing with foreign capital, which is what we have been doing for the last 4 years. And for the last 1.5 years, we're actually also dealing with a lot of domestic capital. And in fact, my feeling is that while we absolutely have the opportunity to attract a lot more foreign capital, In fact, the participation of domestic capital is actually abysmal. And our problems needs to get solved a lot more by domestic capital than by foreign capital. India is not at any point in time going to get cheap foreign capital for development. India, even today, at about 300 million square feet, and this I am talking about only tier 1 cities, right? So out of that 300 million square feet, your 200 million is residential, your about 40 odd million is commercial, your warehousing, I don't know the exact numbers, but probably another 40, 50 million, but in terms of value, it ends up being much lesser, and so on and so forth. So you would see that a lot of, so foreign capital has been very good at buying assets, or actually at supporting some of the more easier to construct, like especially warehousing as a platform, that kind of thing. But your 200 odd million square feet of residential, I don't think foreign capital over the last 15 years, or at least since GFC, has done much on that. Very, very limited. It is happening last 2.5 years, and the credit bit on that has been very good. So that's happening. But we firmly believe that a lot of that will have to come from domestic. And I think Amar pointed to that the interest in credit at this point in time is quite high, right? So that's kind of important. But coming back to your larger question, so what these new things are doing now? So one, the interest of it. So a lot of these things, first of all, they are focused on domestic capital. In fact, a lot of audience that probably we are talking to, which is on the Aditya's platform, is actually domestic capital. They are either investors themselves, they're looking to advise their investors as to how they can touch upon real estate as an asset class in a somewhat different way, right? Today, still, despite everything, I think if there are 100 rupees invested in real estate by domestic guys, I think 99 are still in the physical form only. REITs, a 2019 phenomenon, I think is just about catching up. People are starting to get a good hang of it and starting to feel as to how that works. I think our single family offices, multi-family offices probably understood that the first, and they really love it now. And slowly the broader, maybe some mutual funds and all that's kind of percolating. And then now, last 3-4 years now, with the digital platforms now coming in. So a lot of platforms have already come on the fractional side. We are actually building something which is actually a lot more on the credit side. Personally, our feeling remains that on the fractional, I think nothing beats REITs if you can understand that. They're the best kind of fractionalization in commercial real estate you can get, right? But yes, different investors will have different things. On the other hand, getting good quality credit. I mean, I was in KKR, we were running a book, that book has done okay. But personally, I could never get that 15% return. So why should I only make 5%? Why can't I make 15% as an individual, right? And that has been a little bit of the thought process. But again, in all these digital platforms, most importantly, I think more than they being tech platforms, they have to have core investing DNA. And if I am the investor, I mean, the first thing that I must look at is what is that? Because at the end of the day, what I sell on the platform is only as good as the platform can produce it. So in a nutshell, I think this will certainly proliferate. And this one analogy we have used in other situation also. If we go back, I mean, one of the way to compare it is 25 years ago when mutual funds just about started. Everybody used to invest into equities in a haphazard manner. Tips, everybody will do direct, no seasoned managers, this, that, etc. Participation was limited, and of course, the experience was generally very bad. Out of 100, maybe 2 people will make money out of that. With now this 25 years of history of mutual fund, I mean, we just see where things are. I mean, it's different. So today, all real estate, actually, there is no manager to it for the domestic guy. If you're buying your own land, if you're buying your own office, if you're buying your own flat or whatever you're doing, you are just doing it as the best of your own judgment. And I think these digital platforms, REIT is already a venue which started about 3 years back. All these digital platforms which do well, which are able to create that sensibility of having an investing DNA, should be able to do that for the Indian consumer and Indian investor. That's how I think it should go.
Okay, so by digital platforms, you simply mean the securitization of real estate, right? That's all what we can do. So whether it's through REITs, whether it's through REITs or whether it's through fractional, in the end, all you're doing is taking a big building that's worth 1,000 crores or whatever it is, 5,000 crores, and breaking it up into smaller pieces and selling it to retail investors or HNI investors, right? Is that what you're saying?
So that's exactly what financialization is. Now, how that financialization is being delivered to an investor is taking different forms. So your REITs, which is the most regulated form, and therefore you can just do it on a stock exchange, is kind of now there, and that's happening. That's where you're doing really big buildings, really institutional quality asset class, right? The digital platforms right now are operating in a smaller space, right? I mean, to give you an example of what we are doing on our own thing, of course, I mean, in a typical way, okay, you will take $10 million loans, fractionalize those, which people can invest. But again, you're doing very simple. Like today, you're used to going and buying a Power Finance Corporation bond or an HDFC bond or whatever. They're already AAA rated bonds, right? Which you always had access to. Now these things are allowing you to invest into things which are otherwise probably regulatorily the same, but they offer different yields and different risks. And where you need to communicate that risk very properly, nobody is getting any free return on anything, but it's just that you're getting the benefit of that managed risk, right? So I think the only differentiation I do want to bring about is that most people, even today, when they think of benefiting from fractionalized real estate, generally it comes to the property, and that you can buy a piece of that property using a digital platform or using a REIT. But I think there are many, many different avenues, credit being one of them, which I think is a much larger space overall versus just the strata office buildings.
Right. Okay. I will come back to some of these sub-asset classes in a bit. But one question that Amar and Shobit, you mentioned is domestic investors. I'm just curious, which domestic investors have you not got? I mean, I only see HNIs being, I mean, middle class invest in residential. Okay, we barely can pay our own apartments in our lifetime. Most of the Indian population basically barely manages to pay off their house. They don't have the extra money. So it's basically HNIs, whether you call it a single family office or whether you call it HNI via the private banking sort of channel. They are pretty much it. There are no domestic institutional investors. We have no pension funds, and would insurance sort of investors actually consider real estate? Would they even do that? So I'm just asking, I mean, are we sort of hoping that there'll be a domestic sort of investor class, or do we have to really pitch overseas only?
So domestic includes exactly what you've said. It also includes family offices, which is effectively ultra HNIs and their investments. It also includes corporates and their treasuries. It also includes financial institutions in India.
But corporates, I would have thought, would keep very short-term money, right? I mean, they surely would be better placed, in fact, buying businesses that give much higher ROE to their business rather than buying real estate. If, in fact, my question would be the opposite. Isn't there a whole bunch of real estate sitting on corporate balance sheets that should be offloaded and put into REITs so that it can be picked up by retirees and retail investors who want yield plays? So I'm just saying, is corporate a buyer of real estate or are they a seller of real estate?
Both. So there would be corporates who would do buying, there would be corporates who would try to do selling. But again, looking at the three listed REITs and the quest for absolute grade A plus real estate, I'm not sure how many assets would actually qualify at this point in time. But yeah, when the market deepens and we have more assets coming on stream of various types, various asset classes, I'm sure what you're saying also will happen eventually. But at this point in time, it's these 3-4 segments that is effectively domestic investors, and we are seeing pretty strong momentum at this point. Again, which wasn't there 6 months back. Both on the yield play, which is REIT oriented, even willingness to go into private, non-listed, and then maybe getting the listing pop, or private credit into real estate. Again, decent developers looking at various markets, could be the IT growth cities of the country like Chennai, Bangalore, Hyderabad, Pune, Noida, Gurgaon, or even Bombay, the redevelopment play. So all these aspects is what the HNIs, ultra HNIs, and their family offices are well aware of, and significant amount of capital is coming in.
Okay.
So Hansi, if I were to just add to that, you made the right point. So domestic institutional investing in India is actually pretty bad. I mean, in the sense, most people are regulated. They are not allowed. Insurance companies can buy building, but they can't buy a company which owns a building, which is how a lot of buildings actually trade. right? So there is a huge issue around that, and also therefore actually domestic capital, when we think of it, it's less institutional, it is more individual or personal capital, really, right? If it is credit, then of course financial institutions can participate, but if it is not credit, then many financial institutions can't.
Right.
So that's exactly where I think this difference is, that today, till date, it has been only HNIs or ultra HNIs, because they have to buy these large chunks of property, whether land, office, warehouse, whatever they're buying. Now, if this financialization and fractionalization and bite-sized credit can change that, interest of a 10 lakh rupee guy is as much there. It just says that he has never had the opportunity. So
Right.
let's see how much they will participate.
And one other point which I would like to also highlight is that I would actually define it as pre-2018 and post-2018 because of the NBFC and HFC crisis. So post 2018-19, the entire NBFC HFC appetite for real estate investments has shrunk steadily every year, and that entire demand is now effectively being met by funds, offshore funds, onshore funds, domestic and offshore. And that is the huge potential that investors also realize now, that this market is significantly better in quality assets as compared to what it was till 2018. There's a fair bit of realization on that also. That's coming in.
Right. Okay. Okay. So let's jump into more of these digital platforms. Where does the skill and the risk come from? Assuming that the underlying asset class and the underlying asset can't change, right? I mean, a building is a building is a building. So now the question is, if there's a return that someone is advertising that is 10% plus or 15% or whatever the number is, then somewhere the risk return has been redistributed. Okay. And I'm curious also, one, how is that risk return being redistributed? And two, what skill set should a private wealth firm or an advisor or an investor for that matter look for when evaluating these platforms? So where is the skill being added? And therefore, as if I'm evaluating some of you, what should I focus on? Ashish, perhaps you should go first, and then Shobit, I would love to hear your thoughts as well.
No, I think that's absolutely the right question, because a lot of platforms get positioned on the strength of their tech or how the look and feel is or what it is or how the convenience is. And I think all of that is extremely important, because people are looking for an experience, ease, transparency. To my mind, there are two most fundamental things. If I am investing my own money through any of these platforms, there are basic two things I'm really looking at. First and foremost is, what's the underlying team? Have they done it? Have they not? I mean, I can go to a best looking mutual fund house, but if the team has never really done investing, I should be wary. So first and foremost is how good is the team, and is the team is there skin in the game, which also in many platforms remains a question, right? Like in many, at least in your typical private equity, etc., there is a fair bit of a skin in the game concept. Most LPs would want to look at it. These platforms don't have to really offer that, but if that's being done, I think it's a good hygiene factor to look into. I think first is really like, you will evaluate if you have a good advisor, he should be digging deep into the team's qualification, the team's experience, the team's track record, right? Goes without, if there is no difference than looking at any other financial product.
So just on that, what qualification? I mean, given that unlike other sort of thing, I mean, what qualification should I be looking for?
I mean, it's like if Amar has been doing real estate credit for 20 years, and if Amar is driving that platform, I think there is some comfort that he will do the right thing. And he has gone through his own cycles, and he has seen it. He has seen the good, the bad, the ugly, and he will make the right choices.
Yeah, but unlike in listed equities, in listed equities, when you're buying so many stocks and selling so many stocks, even when you make a lot of mistakes, you can learn very, very quickly. The cycles are the turnover is high. The problem with real estate is that the cycle is so lumpy that I bought a building, and if I don't sell it for 5 years, 10 years, I don't even know whether I made a good decision or not, right? It's like venture capital.
Yeah.
So
that was the problem, Hansi, which when we were all starting, and I think all of us started kind of similar in 2003, 4, 5, and we all had the exact same problem. But I think now you do have people who have been around in the industry doing this for 15 years, having done a bunch of different things, made their own mistakes, some learnings, and I'm sure, I mean, we are still nowhere close to the Western market, so enough and more learning is yet to come. But still, a lot has come. A lot of regulation has come. A lot of cleanliness in the system is happening. So I think it's not that you can't. You can. You just have to start applying. That's not the case.
Right, right. Shobit, your thoughts? Like I said, I think a building has a certain yield, whether it's warehouse, industrial being high yield, then retail, then commercial. What other sort of financial engineering or value add can platforms do? And therefore, what risks am I as an investor taking on?
No, so I'll probably just continue from where Ashish left. Like, look, team experience is very important. What kind of team, what kind of experience they come in with. But most important, before I actually just sort of step back a second, saying most of the domestics, and this I want to sort of categorically mention, is playing credit. And all the dollar money that's really coming in, large part of it is going in equity. So if you want India to build 200 million square feet residential and housing for all, you need to do one of the two things. Either you have to allow mutual funds, insurance companies, etc., to participate and set up sovereign. So you have set up sovereign in the form of Swami Fund, but that's only talking about stuck projects and credit risk. So I think there is no option, but you have to do it. Second, if you want dollar money to come in and support the Indian residential market, right, you then have to allow what is called as build to lease, right? Not everybody has to own his own apartment or a house or a bungalow, right? World has shown us everywhere around the world, there are housing that's called rental housing. You build it, it effectively works the same way as an office, and it produces similar yields, 6-7%, and it competes with office, right? In fact, it may be better than office because it's more fractionalized in terms of rents, right? These can be listed, they can be unlisted. So one, we have to deepen our market, both in terms of equity and in terms of for lease or for rent housing. Coming back to your point, saying, what do I look at on digital platform other than experience is the robustness. How much can you do and how quickly can you do and how quickly can you scale? I don't want to invest in a platform that's investing in 5 deals and then runs out of money, or 6 deals and runs out of money, right? So I need to be sure that any platform that I'm putting money in has scale. If it's subscale, it's going to die naturally, right? So I'm anyways carrying the real estate risk, then I'm carrying the risk of that platform being too small and experimental. So I don't want to be part of any experimental program that's being run. So I think we are still in very nascent stages and this market is still in the test phase. I don't think we have seen anything that's done series B, C, D, it's gone out of the test phase. So I think we are very early on digitization as far as fractional ownerships are concerned. I think Ashish can speak a little bit more.
I think that's absolutely right, Shobit. I think that's exactly the thing. And it's a very early market. And yeah, if these platforms don't scale, then they can't continue for a long period of time. And that is where I also feel that this whole skin in the game is important, because especially when you are early on, because if there is skin in the game and if team is involved, and even if the platforms don't scale, at least there is serious money involved from the sponsors to make sure that at least they get that money back and investors don't suffer on that. So but once they scale to Series B, C, it will be different.
So Shobit, your point is, Shobit, sorry, go on.
Sorry, and I'd like to add also, I think most of these fractional programs that have been set up are not regulated yet. So there is no regulation around how these operate. I think SEBI has not set out any guidelines. It's still not deemed public. So it is not public, it is not SEBI controlled. So these are just random people trying to, I think the earlier they bring this regulation, the better it will become. Don't allow anything to fail and then say, okay, but you did this and therefore now I'm putting a regulation in. I think we should put it in like we did it in REIT. And you mentioned that you were in Australia 30 years ago and REIT came in. So REIT is not a new product, but India regulated it only in 2017. And after that, 2018, 19 saw the first come in. I'm hoping that you first put the framework for these digital platforms and then allow them to run on it. So I know that somebody is watching over me, right? And these are regulated platforms. So right now they're completely unregulated, free to do what they want. So it's a bit of a risk.
Right.
You are setting them up for failure.
Yeah,
Right.
I think that's also very important. And the good part is, I think regulator is getting focused on this though. So on the fractional ownership, I don't think yet anything has come. But like as recent as 2 weeks back, SEBI has now already come on bond trading platforms. They've issued their first consultation paper, and they've actually taken cognizance of the fact that these platforms are, which is not to do with real estate, but it has just to do with credit. Corporate real estate, it could be anything. So yeah. So I mean, the sooner they create that framework, that's good.
So I was telling you about REITs being there. In fact, REITs were actually the name given later. They were actually LPTs, listed property trusts, which only had yield plays, and there were development companies, which were listed just in the normal Australian Stock Exchange. And eventually, the two sectors got merged. So it actually became riskier. Whereas here, our REITs are pure listed trusts. But one other example that we could learn from, again, this is 30 years ago that I started my career, and I would basically sell what were called retail mortgage funds, which is basically loan against property, right? Most mortgage funds were commercial property, but there was one particular one that was residential. And this guy, the sponsor of this, would go around telling the market that therefore his is less risky because against residential property, where actually the borrowing was for commercial purposes, but against the promoters' homes. As it turned out to be riskier, and it was something that I and my boss backed me up on this. I called partly because I think residential doesn't get valued as rationally as commercial or retail or warehousing. Why? Because individuals own their homes and they think their properties are worth more than everybody else's because they think they have done it better. So I'm just saying to you that residential, I think, my personal view of the last 30 years is residential gets mispriced more often because us humans like owning our properties. So Shobit, your point about, yes, we should rent, but nobody does what they should. We do what we want. And owning a dream home is, whether it's an Australian, whether it's an American, whether it's an Indian dream, every country says that we are special. So coming back to this mortgage fund and the learning from that, Ashish, I wanted to ask you, you mentioned sort of fixed return from or debt against real estate. That is developing as an asset class or sub-asset class. Looking at, I mean, is it as simply as there's a property and you do a loan to valuation ratio of 70-80% and borrow against it? Is it that? If so, then why are the returns higher? Is it leveraged up? Like, just explain the asset class a little bit more. And then I would love to hear from Amar and Shobit about investor interest on that, but maybe explain that asset class a bit more.
So I think there are both. So, so Hansi, to clarify, India residential is a dramatically different setup, and in India, 90% of whatever we do is actually primary. So it's not individuals selling homes, it's builders selling homes. And that is where over the last 15 years, there has been a fair amount of discipline, both market driven and regulation driven. Regulation because of RERA and GST and all that stuff, and market driven because a lot of riffraff has been cleared off because customers just don't buy. So there, I think you're dealing with a very different thing. You are seeing a history of a project, how much it is selling, what is the price, what is the volume, what is the market and all that. And like any other development, you can actually make a good assessment if you do it well of what should be the right kind of lending to it. And because of regulation on the banking sector and various different things, a lot of this space was always filled by non-banks as opposed to the banks. Also, generally speaking, banks are very good. The large banks are good at doing a bit corporate conglomerate lending. I mean, many banks are very good at giving money to big groups and all that stuff, where they're doing more of a name-based lending or drawing comfort from that. But very granular, more fragmented markets of players, they get difficult. That's why that was non-banks. But after the credit crisis of 2018, non-banks are a bit out. which is creating this opportunity, which is what even Amar was referring to, that there's a lot of interest in credit. So when we talk about credit to residential, it is actually not credit against a built residential property. It is against developmental projects that are underway. And therefore it is credit being given. So it is secured because it is secured by the land, the value, the construction that is going on, et cetera, et cetera. But there is a development business that is going on under that entity. Okay. Also, there is, of course, a lot of lending that goes on against commercial assets. But there, that's a different game, and that banks are very good at. And the rates there range anywhere around 7%, 7.5%. So that's very different. When we talk about funding developmental projects, that's where the returns are. Like when I was in KKR, that's exactly what I would do. And we would make returns between 15 to 18%, right? So again, but a lot of mistakes have also been made in doing so. So it is a specialized business, and that's where again the expertise of the team, etc., becomes as important, because you are actually, every city has a different regulation, assessment of the counterparty, market strength. Every micro city also has all micro markets. So so that's kind of what it is. So just wanted to make sure that this distinction comes out in terms of credit to real estate.
Amar, do you have something more to add in terms of this real estate debt asset class, in terms of risks? If it is lending to developers, I would have thought it's very high risk, because it's a sector that has political money, black money, regulation risk, delays that happen in our country all the time. All these things can happen. So how much return should we be asking for? And again, coming back to what should we look at?
I think Ashish has given a good overview on that. And to answer your question specifically, I think the sector, real estate debt specifically, has matured quite a bit in the last 7-8 years. And I think it's gradually moving towards a more organized business, perhaps getting more and more in the nature of a consumer FMCG gradually. And at least now the differentiation has come in the minds of finance providers on 3-4 things that are important. One is obviously the developer and the counterparty, and who you do business with, obviously important. Second is at what stage do you invest or lend into the property? Pre-approval, post-approval, if pre-approval, which approvals are there, which approvals are missing, and what's the timeline to obtain the approvals? Is the land been fully aggregated? Is there an acquisition risk? Is there a development plan seeking risk? And obviously the final frontier is a RERA approval. So if the RERA approval, is it 6 months away, 9 months away, 1 month away, 2 years away? That is the question that people, sophisticated lenders do ask. And then after that, obviously the more basic but essential aspects from the developer point of view, which is execution capabilities, which is sales and marketing and CRM capabilities, which is people and corporate governance practices, talent retention at the developer end. And what we've seen in the last few years is consolidation play out to a large extent, and therefore many of the mid and smaller size developers, may not be all, but yeah, quite a few of them, especially those who were over leveraged and did not follow good governance practices, they have been marginalized. There are some smaller ones and mid-sized ones who are doing very well also, but those are the ones who have stuck to good practices, managed to keep their debt low, managed to have things under control on all the fronts, and they are the ones also who are coexisting along with the larger ones in the new scheme of things. So from a lender and a credit point of view, I think stage of investment, nature of the project, earlier people would look at large townships, SEZs, 100, 500, 1,000 acres. Now, if it is more than 10, 15 acres, seems to be difficult to be done in the next 3 to 5 years, raises red flags. That itself will be, I think, enough for next 3 to 5 years. So visible, doable projects, no major ambitions on getting things approved which are out of the ordinary. Return expectations also are not in their 20s as was earlier. Now it is high teens. And when I said high teens, and I talk to developers at the high teens, they come to 15, 16, and then I tell them high teens is not 15, 16. So then I say young adult, which is 18, 19. So nowadays I call it young adult pricing. And therefore, that's the kind of pricing for perhaps land acquisition, perhaps pre-approval to small extent, largely approvals in the picture. And that is attractive from a HNI and family office point of view, because at that kind of yields, there is a strong level of interest in real estate residential debt, which also is attracting a lot of investor interest, because a lot of these developers in the last 2 to 3 years, the good guys, say top 5 to 7 in every city, have deleveraged quite a bit. They have had huge amount of sales because of COVID hiring in these IT cities. They have had consolidation activity, therefore the smaller developers are not as active, and they've been able to sell and collect well. So these are the guys who are buying lands today, and this kind of pricing. So makes sense from investor point of view also.
Right. Okay. So in closing, as I said a couple of times, I used to be Mercer. I have friends still there. I have friends in other sort of consulting firms and some endowments, some family offices. So imagine I take Indian real estate as an asset class to these investors. What is your 2-minute pitch, one at a time? What should I go and tell these overseas investors about why they should be investing in Indian real estate and which particular segment they should be investing in? Shobit, perhaps you can start first.
Yeah, my answer, if I'm taking this to global investors, will be still office, because of familiarity of the tenants, familiarity with buildings. They're very similar. India has the largest stock of green buildings anywhere in the world. So we are building beautiful buildings. You've got it right. And efficiency of capital in terms of deployment, how you can bring it in, how you can take it out, taxation, etc., is all been beaten to death and streamlined. So you don't.
And
have
what
to
returns would I
reinvent.
get? What returns would I get?
You would
Remember,
get
currency adjusted, please.
Currency adjusted, I will answer subsequently, but you will get income plus capital gains included about 15-16% rupee return. If you adjust for dollar, you can shave off 4% to 5%. So you'll get, say, 10-11% dollar return. And you'll get it consistently. So this is a sustainable return profile and not opportunistic.
Right. So that's your bet. You would pitch safe commercial real estate to overseas investors. Thank you very
That's
much.
right.
Amar, what is your pitch?
So I think there are different classes of investors, different tenors and risk thresholds. So obviously the more acceptable bet would be commercial and possibly even warehousing. So income generating, predictable yields, predictable cash flows, good quality assets, and great tenants to showcase. No doubt on that. And yeah, 15 to 17% par for the course, pre-tax, pre-everything, pre-currency. And yeah, so pretty much on the lines, but on the lines of what Shobit said. But in addition to that, there's the vacuum that I'm seeing in real estate residential debt. It reminds me of 2009, 10, 11, because this is what I would do then. There were hardly any capital, fantastic transactions in the market, very less competition from a capital point of view, and good developers to deal with. The problem started from 2015, 16, post demonetization, because mutual funds started lending to NBFCs, and that is when the huge amount of capital came in. But from 11 to 15 was a pretty good run from the earlier cycle point of view. And I see similar with a larger outlay of funds and better developers now for the next 4 to 5 years. Therefore, I would actually I would prefer real estate residential debt if there are investors, and there are, who are interested in it for the next 3 to 5 years, in addition to the pure play commercial.
And would that solve that whole urbanization gap problem that McKinsey highlighted in its very famous report about a gap of 25 million units and stuff like that? Would that solve that?
I think that's more a overall socio-economic and overall urbanization. That may be a longer time frame. But from an investor point of view, I think we're talking about top 5 to 7 cities only, and not the larger tier 2, tier 3 market, which also is a different market, attractive, but I'm not talking about that.
I'll come in to support Amma. I don't think the straight answer to your question is it won't solve that, but I think you start to bridge that gap, because to solve for 25 million dwelling units will take you at least a decade, or
Yeah,
maybe more.
it-
So you
it may
to
be-
see the change will take you time, but directionally we'll be in the same.
It may be one more step, but we are talking about commercial returns for investors, and therefore I would prefer the top 5 to 7 cities for this. Next 3 to 5 years is a good runway. So definitely yes on that. And the third is equity partnerships with developers. Very good developers, maybe top 2, top 3 in each city. There's a dearth of equity capital at the project level, not at the company level, but at the project level, platform level transactions. A lot of them have taken place in commercial real estate, office real estate, not so much in residential.
Right.
That is the next big opportunity also.
Right.
Perhaps in the next 1-2 years, that should be the next one.
Right. So Shobhit and Amar have been very traditional. Ashish, I'm expecting a very innovative answer. Okay, so where are the innovative platforms that we promised investors? Okay, so what are we talking about? So where should they invest?
See, I think so. Two parts. So if you actually think of institutional investors into real estate, I will actually pick both on what Shobhit and Amar has said, but in a very today also.
No diversity of opinion. Like you should disagree with each other.
No, I'm not. I'm going to disagree with them in a certain way. Okay. Point is what Shobhit is saying that has been playing out for the last 15 years. The credit has been on a roll for foreign institutional investors for the last 4 years, especially since 2018. January 2019 is when it started. But these are completely distinct investors. You have the Blackstones, GICs, Ivanhoe Cambridges, and Brookfields of the world that has stuck to buying assets, whether warehousing, office, retail, whatever, yielding assets. And you have the likes of Oaktree, Cerberus, Estee Lauder, and a host of them. Apollo. Apollo deployed almost $1 billion last year in residential credit, with a similar kind of a game being looked at today. So you have both these investors as interested in both these asset classes very clearly. And because the fact remains that India is still a build-out country. I mean, you can keep doing this consistently in office because India still creates 40 million of new office every year. If you don't have it, then it just becomes trading between these counterparties themselves. So point number one, there is appetite among foreign institutional investors for both of these things. The thing is, in India, the largest of asset managers, actually, it has not been blind pool or pooled vehicles. It has been special managed accounts. So HDFC has a special managed account that is for credit also. Kotak has a special managed account that is for assets also and credit also. But they are special managed accounts. If I, as an asset manager, can actually get to say, let me construct a portfolio for you. At this juncture, I would say 50% office or yielding assets and 50% credit, because the vintage of credit is very good. And again, I mean, in investing, it is all a vintage game. Today, the credit vintage is very, very good because residential is on the uptick and capital is not there. On the other hand, warehousing, where operationally it is doing fantastically, there is a wall of capital chasing. I mean, I was at the Camden conference, which is a family office conference, and I'm taking a slightly different example. A mutual fund manager gave a very good example. He said at the height of .com boom, 2000, Wipro had a certain stock price. And Wipro from 2000 to 2008 did extremely well operationally. But the stock price didn't move because it took 8 years for the 2000 stock price to catch up to 2008. So what we are seeing today is certain themes which are loved globally, industrial and warehousing being one of them, have enormous allocation, but extremely difficult to deploy that much capital. On the other hand, you have other themes which are not as well accepted and a little bit more difficult, or their past experience has not been as great. But they're standing at a fantastic vintage, but they're not getting as much allocation. So if we leave it to the domestic experts and who are living, breathing this on a daily basis, they can construct a portfolio. Life is generally not that easy or fair. So people will make their choices and they'll give you the mandate that they want to give you. But if I can get a mandate and then I have the choice to allocate the way I would want, I would do this 50-50 because it does provide a certain amount of stability and familiarity, which also you need to service to an investor, but at the same time benefit from where our vintages are.
Great. Thank you very much. Shobit, Amar, do you disagree with Ashish? Just in case, I'm giving you the last word.
I agree to disagree. I'll save it for later. But no, I'm more or
I
less.
love stirring the pot. That's
I'm
great.
more or less going to agree with Ashish saying a balanced portfolio is nice. I'm not sure whether 50-50 is right, but some kind of a balance between purchasing assets and yielding assets versus debt, credit side.
Okay, great. Thank you. Amar, you happy? You're mute.
Let me just unmute. Yeah. So basically, I think real estate, unlike let's say equity investing, is largely bottoms up, and therefore it is specific to that asset, specific to that location, asset, and micro market, and therefore this percentage of 50-50 can be different across years, across cities, across the kind of transactions that one looks at. So may not be as clear, but yeah, I think overall pretty okay. It also depends on the stage of the cycle globally we are in. Are the risk off, risk on, interest rates moving up, down? That impacts this allocation from a offshore as well as domestic point of view. As you've seen, interest rates here also are tracking there. So I think it's fairly good, good insights from Ashish, and good work being done by him on the digital and tech front.
Right.
Well
I was watching Masaba yesterday. Masaba, this new show with Masaba and Neena Gupta, right? Where the PR lady tells Masaba that you can't agree with all the other judges. You have to disagree. Okay, you have to be a sort of, yeah, not only disagree but also use colorful language to actually go and disagree. So I was hoping that one of you would disagree. But thank you very much. You've been a wonderful panel. Thank you so much. And I hand it back to Aditya. Thanks.
Thank you.
Aditya, you're on mute, I think.
Thank you so much, Hansi, for wonderfully moderating it, and Shobit, Amar, and Ashish. Wonderful having you guys with us. We would love to have some kind of a Q&A from the audience, but we are way out of time. And Ashish is already waiting for his next session where he's going to showcase his platform. So I don't want to make him wait further. We look forward to engaging with all of you guys more, and hopefully now more in-person sessions like we used to do pre-COVID. But thank you for joining in today. Look forward to connect again soon with all of you. So
Thank you.
Audience will
Thank
quickly.
you.
Thank you. Audience will quickly move on to the next session, the first showcase session of the day. Thank you, Shobit.
Thank you so much. Thank you. Bye.
Thank you, everyone. Bye-bye.
So we'll quickly move on to the first showcase session, which is on earnnest.me. And Ashish, one second. You have some PPT?
Yeah, I have a PPT.
Yeah, one second. Just making you the pose.
1 second.
So we are way out of time, but let's look at around 15 minutes.
Yeah. I think that's good enough.
Yeah.
Let me just give me 1 sec. I need to get a handle of my PPT here. So I can just project the way we do normally in Zoom, right?
Yeah. So I mean, audience, you all know the background of earnnest.me already. We put it up on the website, but it is a very interesting fractional real estate investment platform, which is providing some very good high yield opportunities in debt, which are underwritten by real estate. And Ashish is the co-founder, founder of earnnest.me as well as Certus Capital. So he's going to be talking about this new platform that is set up. So Ashish, over to you. And if you have any queries.
No, so I'm going to just share my screen, and then I'll get going with that. Yeah. just facing some problem in sharing the screen. Just one sec. Actually, can you give me 1 second while the screen not sharing?
Sure. Take your time.
Oh, no, forgot it. So I'm going to just rejoin and then I will be get going. Okay.
Sure. Yeah, so I've made
Yeah.
it. Yeah,
All right.
the screen is visible. Yes.
So now I saw. Okay, sorry about that. Yeah, so I think so. Maybe some of the audience already heard what we talked about as a larger theme of different kind of ideas that people can invest into. So, I mean, before starting with the slides, the key thing that I really wanted to bring about was the whole idea of creating Earnest.me as a platform is, institutions had a very different kind of access to real estate opportunities. As we spoke about in the earlier, they've been able to buy the best quality real estate. Some of that is now available to us in the form of REITs. They've been able to do some very interesting credit transactions where those transactions really generate fixed return of anywhere between 14-15%. And they deploy a full suite of monitoring when they do those kind of transactions. At the time of going in, there is a very extensive diligence, very sophisticated documentation, and then a fairly detailed monitoring once the deal is underway. But to most domestic investors, that opportunity has not been there, or even if it has been there, they really don't know exactly what they're investing into. They may just allocate to a fund and all that. And the whole idea about creating Earnest.me was, is there a way to democratize that access to fixed return opportunities that institutions get? All our life, and most of our team, and we'll talk about that a little bit, has done exactly that. We have worked for institutions, or we have deployed institutional money in doing so. But even personally, we never had the opportunity to participate in that. And the idea was that, can we change that? Can we make it a lot more accessible? So that was the thing. I think I mentioned about this earlier in the last presentation also. I think one of the most important thing, and not only for what we are doing here, and a lot of people on this audience may be financial advisors. So goes without saying that there is a need, or it's critically important to ensure that who you are investing your money with, whether it is equity, whether it is debt, whether it is mutual funds, whether it is venture capital, whatever that is. That element you can't really take away. And when we think of digital platforms, many a time that is one aspect that does not get focused as well. But I think that's kind of important. And then, of course, whether it is scalable, how transparent it is. I think transparency is one of the other factors. So I think we have tried to keep some of these things in mind and marry that with where we think we feel is the most compelling opportunity from a risk reward point of view. And around that is what we've created. So I'll go through that. I'll show you a case study. I'll show you something that's about to come about, and just open it up for quick questions if there is time. So first of all, let me just give a little bit of a background about who we as a firm are. Our firm, which we call Certus Capital, and Earnest.me is the platform of that. We started this firm in 2018. Before that, I used to head real estate lending business for KKR, which is a very large $400 billion plus global investment manager. And prior to that, I used to be head of acquisitions for Morgan Stanley India, where we had Oberoi Realty, Panchsheel Group of Pune, some of our investing companies, right? Most of our team, so our team actually come from a similar kind of a background: KKR, Morgan Stanley, Kotak, Piramal, various different Deloitte, and so on and so forth. I will go more into that. And over the last 4 years, also we have advised global institutional investors in helping them invest or commit almost close to 10,000 crores. We have bid for lending platforms. We have looked through more than 40,000 odd crore of loans. We hold an NBFC license. We hold an AIF license. That Earnest.me, as you see it, is our platform that allows you to participate in secured debt, which is secured against real estate. So that's just the background. I can't change this slide. Just one sec. Can you see the Anisha?
Yeah.
If
We can see.
Yeah. Okay, fine. I got it here. Sorry, I'm just struggling with this IT a little bit today. So this is just a bit of a snapshot of the team, but more than this. So this is really what it is. I mean, as a team, we have done almost $3 billion, more than 15,000 crore of investing. This is where most of our team has worked. So a lot of this team comes from core financial services background across real estate, mutual fund industry, etc., consulting, sovereign wealth funds, and so on and so forth. But now jumping straight into the platform. So what are we really trying to do with Earnest.me? The point really, what we're trying to do is, there is a deep need of debt for the real estate sector. Annual market, in our opinion, is close to $15 billion, and it is severely underserved at this point in time. And there are various different people who can participate in that. Of course, lending institutions have already participated, continue to participate in their own way. But this is the space, really, which have not had the opportunity to participate in a meaningful way or in a very transparent way. And that's kind of really what we want to solve for when we talk about Earnest.me. So really, what are we trying to do here? I mean, the whole thing is that if I'm an investor and I'm trying to invest my personal money, I have options on equities. I have had enough and more options on VC kind of funds. Bank deposits is where a lot of money lies. Debt mutual funds are there. AA and AAA bonds have been accessible, but it leaves, like, if you want to really make more than 10% plus post-tax return, you have to go to equities, or you have to go to these VCP funds. You really had very limited access to fixed income instruments that can give you that, which will give you regular pay and which is really taking away any kind of equity market risk, which at an institutional level, enough and more of that happens. In fact, private credit is one of the largest themes globally, even for institutions. And Earnest is actually trying to solve for that, provide that. There is, I mean, I would certainly say there is more risk than a AAA bond, but there is much significantly higher return. And that's really exactly where our team comes into play. Whatever we invest into, we invest our personal money also. So there is a bit of an alignment in terms of what we're trying to do there. So that's kind of the positioning of what we're trying to do. So what do you really get as an investor? First of all, we are also investing in this thing. They're made easy. You can understand them properly. Typically speaking, we are operating at 14 to 15% return. Most of those deals properly provide you quarterly cash flows. So, so quarter on quarter, you get interest. Over a 2 to 3 year period, they will pay the principal back, and this is fixed. So you're really not taking a view on, okay, I'm buying a fractional portion of this building, and this is going to sell at. I bought it for 100 rupees. Will it sell at 125 rupees? Or like if I'm holding it for 5 years, is it actually producing 5 year or 5 rupee of capital gain every year or not? You're not doing that. Whatever you're seeing here is what you really get as a fixed return. Typically, a lot of these things were only available to ultra HNIs and HNIs with minimum ticket sizes of 1 crore or more. We have lowered that down to 10 lakhs. You know exactly what the underlying deal is before you do, and it's your choice to do it or not. So it's not a blind pool. You look at it and you make a choice whether you want to invest into it or not. So this is, I mean, without giving too much theory, I think we thought it will be much easier for people to understand if we were to just say. So this is an actual deal that we just finished up recently. It was a 40 crore investment with a group which has 35 years of history. They have delivered 65 lakh square feet. You know, what we invested into was covered more than 2.4 times in terms of future cash flow versus our investment. Gave a fixed return of 16%, right? Interest pays out quarterly. This was done in January. 2 quarters of interest have already been paid out. And we, as a team, also invested 6 crores out of this 40. So we're a fair amount of participation that we do in that. And the minimum that one had to do was 10 lakhs. So how was the participation in this? You know, what did we see? So, you know, this is really, you can see, this is just a summary of what we just talked about. But now this is fully sold out. But basically, 113 investors participated across the segment. You know, we had close to 80 investors between 10 to 25 lakhs, about 20 investors between 25 to 1 crore, 12 investors more than 1 crore, and so on and so forth. A lot of people directly participated on the platform, but also through distributors, right? So a fair amount of distributors actually showed good interest in this one. So I think, so that's kind of, you know, this just a, so effectively what you should take away from this thing is that, and Amar also mentioned on this thing, HNIs, multifamily offices, large institutional investors, and I'll come to that, you know, have been very actively looking at this thing. But this kind of an opportunity has not been accessible to a much larger segment of investors. And that's exactly the mission of Earnest, that we should democratize that access, and it should be very, very simple. So, you know, so it's very easy to see and what's going on. And then also what happens is that whatever you have invested into, you have your own portal. So you know exactly how much you invested into, what you have to still invest, what's going on with the underlying project, what are your upcoming transactions, what are your documents. So it's just all digitally available to you. And the entire investment process can be done digitally. Plus, at the same time, our team is available to talk to you and help you understand what we're investing into. And here is an example of another transaction that we are about to close. We are in the final stages of evaluation and closure. Again, a very advanced project in Pune, which will offer 15% fixed return, very strong cover, again, a very good counterparty, someone I've even dealt with during my KKR days. So the borrowers that we're dealing with, they have institutional background. You know, they have dealt with large institutions. So they're used to dealing with institutions. They understand what their requirements are, and that's exactly how we run. So all these things go through the same level of diligence and documentation that will happen by a typical institution. That's why we say, when you invest through Earnest, you're really getting a similar kind of assessment and process that generally is available only to the institutions otherwise. I think this, we all talked about it in the last session, but this is what I wanted to give a perspective on. It's not just that we love this theme. It is that all the major institutions, and you can see a lot of these people, they're all Indian, HDFC, Kotak, Ask, and these are all announced numbers or actually raised numbers. So they all have raised money or are actively deploying money to invest into this theme. This is all the money raised for investing into residential segment, largely in the credit space. And it just is really a perspective on how smart money or how institutional money is looking at the same opportunity that we're talking about at Earnest. So again, I spoke about it earlier. It's really a question of where you are. So to give you a stock market analogy, if you had invested in 2007, versus if you invested in 2009 in the stock market, just after the GFC, of course, the returns that you would have made will be dramatically different. Market was at 22,000, it dropped to 8,000, right? And I think somewhat of that nature has happened with real estate credit over the last 3-4 years after ILFF, which actually didn't have anything to do with real estate. But when it defaulted, it created a problem for the financial services and lending institutions at large. And they stopped lending to into corporate loans, including real estate. So on one hand, the money dried up. On the other hand, the sector is doing very well. Most of the listed companies had their best year. Real estate listed companies like Lodha, Oberoi, etc., had their best year ever in FY22, and that's the kind of momentum they're seeing. And that is why a lot of this institutional money is actually chasing this kind of an opportunity. So, I mean, I already kind of talked about that, but here is just, I mean, I talked about how the momentum is, but this is just to, there's a lot of data here, but the basic takeaway is that some of the things, this is Q2, which is Jan to March 2022, it has been one of the best quarters ever, right? And this momentum, despite the increase in home loan rates, because RBI has raised the rates by about 1.5% over the last 4 months, but despite the home loan rates moving somewhere from 6.5% to close to about 7.5% now, the momentum is continuing. Because, in our opinion, and I think Chairman of Lodha on its earnings call recently kind of mentioned that up to 8 to 8.5%, we still feel that consumers want to buy. COVID has only increased the desire of consumers to have their own homes and have it the way they want it, right? So most people are buying the best home that they can buy. Yeah, enough and more people still have to stay on rent, but then also that home has to still be provided by someone. So I think, so net, I don't want to take too much time into the going into the detailing of it, but happy to answer any question. But that just was a quick summary of what we're doing at Earnest.
Yeah, Ashish, are you done?
I think, yeah, I mean, we can open it up for questions, Aditya, if you have time. But that was the idea, to give a high level summary.
Not actually. We are getting 10 minutes beyond schedule.
Right.
No, so what we'll do, Ashish, I think, I know this is a very, very interesting space, and you bring in a very, very rich perspective to it. Maybe we can have a standalone session once our IPI is over.
Right.
And I think it will be easier for people also to connect directly.
I think that makes sense.
Right now, I think I'll have to move on to the next speaker whose slot was
Fair
scheduled.
enough. No, I think it was great to be here, Aditya, and thanks for organizing this. So we'll be happy to do a separate session for your audience.
Okay. Thank you so much.
Thank you. Thank you, everyone.
Take care.
Bye-bye.
The audience, I think Manish is not yet joined in. Our next speaker. We'll just wait for a few more minutes for him to be here. Hey, hi, Manish. Hello.
Hi.
Hi. Okay, we were waiting for you. Do you have a presentation that you'd like to share? Or you want to talk?
I would be happy to do an open, session. I can do a presentation, but it becomes very boring.
Okay. No, so idea is this is a showcase session on RealX, and the audience is not joined in through Zoom. And we are
Okay.
running a bit late, so we have around 10-15 minutes. So it will be good to just keep it to the showcase of RealX and what you're trying to do with the platform, what kind of opportunities it has for investors or even other partners and service providers.
Okay.
So if you have a presentation, fine. Otherwise, you can just continue with the talk.
What time do we start?
Oh, we are already running behind schedule. It was supposed to start at 5:40.
Mhm.
So we have another session at 6. So I think we'll just have another 15 minutes max.
Okay.
So
Are we on or we'll have to start in 15 minutes?
No, we are on. It's live.
Oh, okay.
Yeah, so audience is already here. So audience, welcoming Manish Kumar, who's the founder of Grex and RealX here. I think RealX is trying to do something interesting in the real estate investment space. I do not, unfortunately, have the time to do a full-fledged introduction. So Manish, I'll rather do your, intro on RealX and yourself do the talking. We have just about 12 to 15 minutes to hear about you and what you're trying to build.
Okay. So what I would do is I would use this time for something more generic and maybe later explain RealX. Can you pass on the control to me so that I can open up a deck?
Sure. Yeah. So the co-host now.
Yeah. Thank you.
So
I hope my screen is visible.
yeah, it is.
So this is a presentation that I've been doing in a few occasions, which is more generic to the concept of what does it take to tokenize real world assets, and real estate being one of the largest pies of real world assets that obviously has not been digitized yet. And if you digitize and then tokenize, then what does it take to do that? So it's more generic about what will it take, and then I will be happy to go ahead and talk about RealX as well. Some background, the times are changing with changing times. The whole industry around asset management, wealth management is changing. There are new assets, there are new platforms, there are new strategies, there are new ways of deploying capital, there are new exchanges. And I think it was very incumbent upon time that real estate, being the biggest of the asset class in anybody's portfolio, also came around and kind of change. I mean, we saw some change in the way real estate is invested upon. So, and that is happening with fractional ownership of real estate coming in. I am co-founder of RealX. What we are doing at RealX is enabling you to, as an investor, to buy, hold, and sell, fractional ownership in properties. You essentially by becoming co-owners in the property, and we do it through legitimate means possible today. Now, coming back, so what is the big opportunity overall? Tokenization, as we have seen in the last 2 odd years, has taken up big time, and we have seen even memes being tokenized, even photos being tokenized, some genuine, some just fake or just for fun. However, what has been established is that there is an appetite for such digital assets, and if if we could ever come around where traditional investment instruments and traditional assets could be digitized, and presented in the form that tokens represent, I think there is a huge appetite of merging of the what is called TradFi and DeFi world. And in there, what I call is the holy grail is real estate tokenization, and that is what RealX is working on. What is digitization of real world asset? Essentially, what it means is you create a token which has a linking with the real asset. It has the linking may be by means of the rights over certain income stream of the asset, the rights over some IP of the asset, or or direct ownership of the asset. So that is what we mean when we talk about digitization of real world asset. What are we talking about in terms of market? The global NFT market was 338 million in 2020, and it zoomed to 41 billion in 2021. So by the way, before I proceed, one of the things that you would have noticed is, and you would have seen somebody coming from Strata also and talking, that we do belong to the fractional ownership sector, but we are in no way doing it the way almost all our peers are going about doing it. So almost all our peers essentially create an SPV company and house the asset in the SPV company, and then issue securities of the SPV company. We, from the word go, did not want to do that. It has taken us a long amount of time to do our research and figure out a way such that investors in the real estate assets do not get do not have to have a legal ownership or ownership incidents on a intermediate vehicle. So what we offer is a direct co-ownership over which has direct ownership or direct co-ownership rights whenever we tokenize of the real asset, and there is no intermediary vehicle in between. This happens through a elaborate set of arrangement, and the framework has had to be created, etc. And that all work was done by RealX. In some sense, it's a pioneering work and one of its kind in the world. Coming back to the presentation here, what does it take to create digital assets from real world assets? First, there are 4 or 5 steps involved. First step is asset verification. So even at RealX, when we take an asset, we do verify the authenticity of the asset and things like that. Then there is the asset has to be sold, so it has to be fully subscribed onto the platform. Once the sale process is through, that's when we go to the real changes happen on the ground. The asset custody has to be transferred, in our case through a registered sale deed. The asset custody has to be transferred to the custodian of the asset, and thereafter the tokens will be generated or minted and issued into the wallets of the owners of whomsoever has invested. Beyond that, there are two things that will happen in parallel. One is the asset operations and maintenance, which has its own set of ecosystem players. The reason why I'm not going in detail in this is if 15 minutes will be too short, so I decided to keep it more generic this time. And aside of, so on the asset side, there is asset operations and maintenance, and on the ownership side, the token holders or the co-owners can exchange hands on the secondary markets or the exchanges. What are the key challenges of doing something like that? Existing laws. Now, for example, for us it took 2.5 years to design the whole architecture within the existing laws. Can it be still better? Yes, it can be. If the laws are improved, then it definitely can be better. To give you an example, we had not issued tokens yet. What we had done was so far legally establish co-ownership of the properties through the registry system, and their systems prevail as they prevail today, and we're able to record such co-ownerships on blockchain. Now, why did we not tokenize yet? Because we didn't know the real government and the tax position on on the tokens as yet, and we didn't want our investors to be kind of investigated and them having to answer tougher questions where the answers were unclear. Now, having said that, few days back, the government came out with a clarification that NFTs issued, such NFTs which have a legal basis, which represent ownership of a real asset, will not be treated, on par with the crypto tokens. So that clarification has kind of paved the way for us to now focus our attention and take the next step, which is tokenize the records that we already had on blockchain. So that is where we are. Number two is service provider ecosystem. When I say service provider ecosystem, it means ecosystem of custodians, ecosystem in this case our properties are managed by property managers, or asset managers as we call them. The whole ecosystem of such providers need to evolve for such for real world tokenization to come about. The third and very interesting one is market acceptance. To tell you the truth, it has been a difficult journey for us to go and talk to even some of the most savvy developers, because they all have reputation risk, and they all refer the whole RealX model to their legal teams. Almost everywhere we went, whether it is a wealth management firm, whether it is some significant investor, whether it is a developer, the market acceptance took way longer for us. Why? Because this was something new, it has never been done before, and everyone had to kind of validate it for themselves before they could tie up with us. I'm happy to say that almost everywhere we kind of cleared it, but that market acceptance takes time if you're doing something very different and very disruptive. And number four is technology evolution and ecosystem. Why I say that is that was another reason why we had not yet tokenized, because RealX is all about real world incomes and asset ownerships, etc. So the biggest hurdle in that we were facing was the gas fees. So if we tokenize into any ecosystem, whether it is Ethereum or someone else, the gas fees itself was prohibitively difficult to assess, and that would have taken away a lot of our investor returns. That is one reason why we were looking at the whole technology space to kind of evolve. So even in the level 2 systems like Polygon, etc., they are still evolving to a point where until we are not convinced that they would remain stable and the solutions that we launch on their platforms will not erode my customers returns significantly, we have a lot of reservations to signing up for any technology. So that is another thing that has to evolve and come around. So I give you a ringside view of what RealX is. What are we overall doing? We are a digital investment platform for ownerships in high yield, high return properties. We digitize property ownership legally and record such ownerships on our blockchain technology called PropChain. It has taken us a lot of insights from finance, legal, technology, and real estate to build something like this. So this is what I had in mind. I didn't know that we wouldn't have audience talking, so I thought there would be some space for me to engage. But I'm done otherwise, if I could say.
No. So Manish, the audience is joined in through a separate platform. The speakers are on Zoom.
Okay.
But the problem is we were running behind schedule a bit. So taking Q&A is becoming difficult. So we had to avoid that in the earlier session also with Ashish. So what we'll do, but I think we can always have a standalone session with you. I think after Greg's days, we've not had that. And I think, believe now the regulations also, they're also getting in place. Things are happening, I think, taking interesting turns. So both on this as well as the other part, you bring a whole load of experience and expertise, and it will be good to have you sometime doing just a standalone session. So let's work on that. For today, I think we'll have to skip the Q&A part and move on to the next one.
Sure. No issues. Let me try and
But thank you so much for joining in. I wish you all the best with RealX, and look forward to catch up soon.
Thank you.
Thank you. Bye.
Thank you again. Bye-bye.
Hello, when is it starting?
Hey, hi, Sudarshan.
Hi, I'm here.
Hey, we were just waiting for you. Great.
The last 3-4 minutes.
Yeah, you have any presentation that you like to share?
Would love to, yes.
Okay, so we are slightly running behind schedule. We have another 15 minutes. So idea behind this entire session is just to showcase Strata as a platform and hear from more about you from, what kind of opportunities it has for investors or even channel partners or other distributors. The audience has joined in through a separate platform.
Sure.
We would have loved to have some Q&A, but I think we are running behind schedule. So we'll just focus on the showcase your talk today, and we'll request audience to reach out to you directly. Of course, if merited, I mean, we can also always have a separate standalone session with you sometime and the audience directly after this entire initiative is over. So thank you so much for joining in. And audience, we have here Sudarshan, who's the co-founder of Strata. They're trying to build an investing real estate investment platform. And this is the third and final showcase for the day. And Sudarshan, over to you. You're the co-host now. And I'm here if you need any technical support.
Sounds great. All right, thank you. Great, guys. I'll just take you guys through a simple walkthrough to the entire conversation so that it's more easier for everyone to speak, right? I'm sure many of the other speakers have spoken about real estate in general, but one of our core thesis for everything was to create a passive rental income portfolio for investors. To what RealX does, to what other platforms, etc., do, be very, very clear that there is a good chunk of investors who want to have their money safe. They don't want to take structured debt as a portfolio for themselves or a part of the wallet share. They don't want behind these risky investments. They want to enter more safer asset classes. I'm sure most of your clients would also love. I think Indians love rental income, interest income, dividend. Dividend is a very smaller amount, irrespectively today, but interest income, and this is what it is. So when we went deeper, we realized investors invest tremendous amount of money into gold, into FD bonds, into residential real estate as an investment, not as an end use. That's a staggering amount of money. And when we went deeper, why are people investing in residential real estate? Is prima facie because that's the only thing in real estate which is in the range of about 1 to 5 crores at maximum, which they could invest. I mean, owning a commercial real estate is of literally a far-fetched idea to most of them. And that's why we are coming in, trying to bridge the gap by making them giving them access to, high rent yielding grade A commercial real estate as such. How has CRE performed over other asset classes? Barring last year, best in terms of its performance, and that last year's performance you can see now because CRE has really outperformed. You can come to Bangalore and you'll not find office spaces anymore because everything is taken right now. So best two asset classes in terms of performing for over a decade now, ever since the 2008 crash happened, and this is what it is. And now we are entering to a recession, at least that's what the world says. Again, best time for people to start looking at commercial real estate as an investment asset class. I think we'll become great bargain hunters to great deals. There'll be a lot of distress in the market, which means better investment returns for those who have a 7 to 10 year kind of an investment mindset. So this is not for your clients or for people who have a 2 to 3 year investment mindset. This is ideally for good 5, 7 year, 10 year investment timeframes is what is recommended for investors as such. So CRE has not been mainstream prima facie because of its high capital requirement, because it's expensive as an asset class. It's 30, 40, 50 crores of a floor of a building, not the entire building in itself, of a grade A building with a grade A client. So that has been one of the biggest deterrent why not many people have invested into this segment. Second is inaccessibility. These are not properties which you'll find on your magicbricks.com, your nobroker.com. These are really expensive properties which are traded in smaller communities, smaller groups of ultra HNIs who have 40, 50 crores to disburse and buy such assets. Then comes concentrated exposure as wealth advisors, and as you guys are, you would always advise people to diversify, but real estate never gives you an opportunity to diversify. That's why we are trying to come in and helping people diversify their portfolio across multiple assets. And then the whole bigger challenge for everybody, especially non-resident Indians, and we have 25% of our platform as non-resident Indians today, is asset management in itself, right? So once you buy the property, how do you manage the asset? Whether you are in India or abroad, it's a painful task for people, right? Like for instance, after you acquire, taking care of property tax, insurance, leasing, releasing, etc. Because the ones who are investing in real estate, it's not their core business. They're actually parking their passive money. The ones who are into core business actually make and sell and leave, right? So that's the whole difference. And where asset management and tenant management, especially in today's world, tenant relationships are a very, very critical thing, which people are not aware of as such. So we as a platform bring in 25 lakh rupee ticket sizes for investors. We create an SPV which goes and acquires the property, a very institutional way of doing, pretty much copying to what most of these large funds operate by floating a trust. The trust eventually floats an SPV to buy the property. What we do different is, instead of a blind pool investment where investors are not aware where the money is going, and there have been clear precedents, whether it's Aditya Birla, Unitech, CIG, multiple funds have lost investor money. Here we are going up because they've invested into under construction projects, etc. Here we are going after completed rent yielding grade A assets, leased to grade A clients also at the same time, right? So that's pretty much the business model. We float a company, and then investors, instead of a fund where they had a blind pool and the fund manager was taking a call, investors take a call by choosing which investment property they want to invest in multiples of 25 and 5 lakhs beyond, right? So that is the bigger opportunity as such. We today work with close to about 1,000 plus odd wealth managers in India, including IFAs and certain boutique wealth firms as well, who offer this as a financial security to its customers, as in real estate investment product to its investors, because most of these guys with whom we work with right now don't even get an opportunity to sell real estate to them or advise people on real estate or even manage their real estate portfolio in a short way. So it's 25 lakh rupee investment minimum. Everything is online from an investment standpoint, right from signing documents to reviewing the entire paper documents before of the property, whether it's legal opinion, etc., plan sanctions, etc. The recent sale lease transactions of a particular property, we plugged in with PropStack, which gives us that access to investors for them to track on a real-time basis what's the other sale and lease transactions which have happened. And then we help them sell their entire asset at the same time. Now, again, reiterating, this is only for those people, and you should advise only for those investors who have a wallet share of at least 5 to 10 years. Anything lower than that, absolutely not a recommended product for them, because we're not here only for 8, 9, 10% rental returns. We're here for the appreciation. And appreciation is a long haul game. You need to stay invested before a market matures, and only then value appreciation can be created for investors. Now, how do we choose our properties? Very critical is we go through a stringent process, understand the location advantage, the specs of the property, who are the other tenant profiles in the property before we take a call, understanding it, whether it's a back office, whether it's a product office, whether it's a front office, etc. Take care of entire due diligence. So typically we go after grade A plus assets, which are already leased to grade A clients. So 4 layers of due diligence is already done. A developer does his due diligence. Then the bank which funds under construction does its due diligence. Then the tenant which is picking up a property does its due diligence. And then we come and do another layer of due diligence, and then we acquire a property. So a good chunk of due diligence is done. So, that way legal, at least from that point of view, is fairly simple and straightforward. Tenant research, very important. We look at who are the tenants, their credit rating, their financial capability of paying, what are the actual businesses they are operating from there, the stickiness, etc. accordingly. Do a financial analysis of the entire investment over a 10-year duration. What is the IRR returns we can make for our investors? And then we propose an opportunity by listing after it gets approved by our investment committee through our platform. We partnered with PropStack, which gives access to all the sale, lease, loan, mortgage data, which again is shared to our investors before we decide to invest, so that they're aware, okay, if I'm buying, who's the neighbor, how much rents are they paying, how much am I getting, etc. All that information is there in front of the hands of the investor before they decide to invest. So our structure is clear. We don't follow any NFTs, tokenization, etc. We wanted to keep it as institutional as possible as of today. Investors invest through an escrow account, which we've created for investors once they do a KYC on our platform. We move the entire money to an SPV by allocating 2 types of securities, equity and debentures. The reason we do compulsory convertible debentures is so that it's pro rata to the rent, the coupon rate. So whatever money which the asset is sending to the SPV can pass it to the investor on a month-on-month basis. And Strata acts as an asset manager. We don't invest in any of our properties at any given point of time because we feel it's clear conflict. Because of the liquid nature of our investment product, we don't want a situation where, hey, Strata knows something's going wrong and it downsells it to an investor and walks out. So hence, we don't invest, and we find that to be clear conflicting as such. The investor dashboard is something I want to show you guys. It's a clear dashboard for investors. Likewise, we have a partner dashboard as well, where you as partners can do a KYC. You either need to have a RERA or some kind of a SEBI registration or a CS certificate, and you can partner with us and you can offer this as an investment product to your clients. I'll take you guys through that later, but otherwise, investor can open multiple family accounts and log in and invest through his multiple family accounts, because we've realized most of the investors, the men decide from a tax planning standpoint through multiple profiles. So no point having multiple login ID password, one login ID password, and you can track everything. All your transactions, buy, sell, rent, interest transactions with the UTR number, etc., is available on the dashboard itself for you to see how much money the company made, how much money got distributed to me on a month-on-month basis, what is property tax, what is interest on security deposit, etc., all made available to you. The reports, your monthly investor rent report, TDS report, along with the TDS certificate for every opportunity. Quarter on quarter is available. So for his tax planning, for advanced tax, and his income tax filing, including consolidated report, which again goes on email to investors as well. And likewise to you as partners, you'll get access to your investors report so that you can also help him, because many of them are even financial advisors rather than just wealth managers. Documents, again, all the property documents, the share certificates of the SPV, again, all available. We obtain valuation certificates every 6 months. So even that is available on the dashboard for the investors for them to track at any given point of time. And whenever they want to set up a call at any given point of time, it's simple. Again, for people who invest via partners, they can, even you can set up a call through the partner platform very, very simply, so that it can be a seamless transaction before and post investment for the investors. So that's how the whole dashboard operates for investors. Very, very transparent. There's a mobile application as well, which investors get as an access for them to start reviewing things. What all we handle for investors, take care of the entire lease management, tenancy management, asset upkeep. We take a half-yearly valuation report for investors so that they can track their investment returns and understand what is going on in the market. And then there's a dashboard, which I just showed you, which takes you through everything. For NRIs can invest from the NRE or NRO accounts, but we transfer rents to them only to the NRO accounts on a month-on-month basis. And TDS is subject to the double taxation avoidance, or the TRC, is accordingly the TDS is deducted for the investors. Now, very important question is, how does one sell and who it is for? One is, at the end of 3 years, we call for a simple online poll and ask our investors. If majority say yes, go ahead and sell the asset, then we go ahead and sell the asset. Otherwise, we continue enjoying the rents for our investors. Otherwise, investors can even do a private sale transaction, which we can also facilitate for them. A friend can sell to another friend if required, and a resale platform. So we have a 6-month-old resale window, and there's a 6 months lock-in, and where one can look at liquidating its holding during the during those resale windows which we create for investors as such. We facilitate for over 11 crores of resale. These are investors, especially during the second and the third wave, which wanted money. But again, reiterating, not meant for investors who are parking that wallet share with a 2-year, 3-year, 4-year mindset. This is minimum 5 to 7 years. Otherwise, it's not ideal as an investment asset class. Who can invest? Everyone. We don't accept money from trusts as of today. From minors as a second approach are the only 2 things which people cannot invest. Rest everything else is absolutely permissible through our platform as of today. So minimum is 25 lakhs. 5 to 7 years is the minimum recommended investment time frame. Average rental returns we've been able to generate for investors are at least 8% as minimum, which goes up to 12%. And IRRs can be from 10 to 16% as an average. We don't leverage our investments today. The next property which we're doing is going to be a leverage opportunity where investors will have the ability to leverage their investment as well, which will enhance their post-tax returns and obviously their IRR as well. People ask us a very common question, hey, what's the difference between you and a REIT? I would rather invest in the REIT. I mean, a simple answer is, why do people buy stock when they can buy a mutual fund itself, right? So, but having said that, the core difference is REITs are publicly traded, which means it's subject to its stock market volatility as well. This is directly, and we've seen as a classic example, look at Embassy REIT as an example, listed at 300, went up to 480, today trading at about 360 rupee levels. Investors don't want a part of their real estate portfolio investment to be as volatile as it is and seeing it on a regular basis. So imagine an investor investing at 400 rupees. He's in red today and he's making sub 5% returns overall on his investment, right? So that's how REITs are. There's unfortunately not a direct correlation to its underlying real estate value, because at 300 rupee, you were supposed to make about 7% returns. When it jumped to 480 rupees, you effectively made just 3% returns on your investment returns. And now at 360, you're making 5.5% as investment return, right? So there's no direct correlation. Did the real estate price underneath jump from 300 to 480, crash to 300, and is now trading at 360? Unfortunately, that's one of the core problems of what the REIT has. So your investors have direct control, which property, what's happening, etc., etc. So it's more direct real estate buying, just that it's a financial instrument versus a REIT, which is a pool where you have no idea who the tenants are, what's happening. They have hotels, which can have its own cyclical risks and multiple other challenges also at the same time. Your entire money gets distributed to the investors on a month-on-month basis versus a REIT, which should only distribute 90% of the net distributable cash flows, which means REIT also have a lot of loan on their books. So only after whatever is paid out, whatever spending is what 90% they have to distribute. Not everything needs to be distributed to the investors. Here, no loan, which means 100% is completely controlled by the investors as such, without any kind of debt. What are the risks? Very important to understand the risk. Pros can be great, but it's always important for you to understand what are the possible downfalls. Capital risk is low because it's effectively going into a real estate itself and grade A plus asset, and we generate rental income. So we buy pre-leased assets, which means if there's no tenant, we don't invest as such at any given point of time. And ownership is with the SPV itself. Liquidity risk is medium. Like I said, minimum investment time frame is 5 years, and it's not gold that you can liquidate tomorrow. So it's highly recommended for investors with a wallet share of a long-term, how real estate is in general, or long-term and illiquid this is, but obviously we're creating a lot of liquidity windows through resale and private sale windows through which people can liquidate their holdings. Real estate risk is low. Again, we take care of due diligence from premium tenant, from premium law firms, and likewise, reputed companies who are occupying our properties also go through scrupulous amount of legal due diligence before they lease a particular property. And tenancy risk is low. Again, in comparison, if you had bought the property yourself versus me, I'll outright beat you in terms of asset management because that's what my core business is. We buy pre-leased assets, and we're very proactively, especially with the data which we have, we are very proactively tracking what's happening, and we are able to pitch to those tenants to lease our particular property also at any given point of time. So just about us, it's been just about 2 years in terms of an operational business which we run. We have 2.6 million square feet under management, 700 crores which we manage of our investors' money, about 2,000 investors on our platform. We have tenants like Puma, Westside, Wakefit, Capgemini, Randox, Swiss Bank, etc. These are all the kind of properties. So in true sense, we've diversified our investors' money in a factory, in a warehouse, in an office space, and a retail, and not just in tier 1 cities, but even in tier 2 cities like a Jaipur market as well, is what we've successfully done. So, we have a couple of investors who invested in all our properties. In true sense, they've diversified their portfolio and have hedged their risk with any one industry or one market or one micro market or one asset class going through a downfall at any given point of time. Just our last properties which we had funded, the Pune one was leased to Tata Autocom, Westside, KT was a Puma opportunity, etc. These are all the kind of deals which we've been doing on a platform on a regular basis as such. A leadership team is people who come with varied years of experience into that domain. I was a lawyer and from real estate background as family as such, but understanding the criticalities of legal is I think what 80% of real estate is. 20% is understanding the commercial side, I think, which is not rocket science in general. Priyanka was earlier with WeWork as the real estate acquisition analyst. So all the acquisitions which WeWork has done is all done along with the team which she was managing. Niyar heads our investments. He was the vice president at Piramal prior to this, and a bunch of other people who come from varied years of experience from asset management, leasing, etc. Through our platform. We've raised 2 rounds of funding from premier tier 1 VC funds called Elevation, which was early investors of Swiggy, Make My Trip, Meesho, Book My Show, etc. Kotak Investment Advisors is the largest private equity arm in India in terms of domestic real estate fund. They manage close to $5.5 billion. Mayfield is an American VC fund, early investors of BharatMatrimony.com, Licious, etc. And Gruos is a VC fund of Nikhil Kamath from Zerodha and Abhijit Pai. All our property documents, we don't maintain ourselves. It's all kept with universal trusteeship. It's an ICICI portfolio, so it's all maintained by them. Any investors who want to physically review anything needs to give us a couple of days heads up, and they can go and physically review the documents. Otherwise, scanned documents are all available on the dashboard. Our trustees are Vistra. We bank with ICICI Bank and we bank with HDFC Bank for all our SPVs as such, right? So that's a quick thing about what we do and how we've been working very closely with a lot of partners like y'all and offer this as an investment product to their end investors and clients as such. Yeah, that's about it.
Awesome, Sudarshan. I mean, That's one of the cleanest and very, very crisp talks I've heard in such a short time. Thank you so much for coming in. Very, very impressive, the kind of feats you already achieved in the last 2 years. I mean, the first 2 years of your operations. I'm sure it's just the start for you guys, and you guys are going to scale a lot of new heights. Thank you for joining in. Audience, we would have loved to have Sudarshan with us for slightly longer for the Q&A, but hopefully he agrees for a standalone session soon, and we will do that either online or in person. Sudarshan, so if I mean, Equalify, as we discussed on the call last time, I mean, it's primarily a membership body for financial services professionals, and a lot of wealth advisors are part of it. So you did discuss about the distribution side, the channel partner kind of a segment. So who's the right person in your team for people who are interested to reach out to?
So it's simple. It'll be difficult because we've now spread our team across multiple locations. So it's simple. You could just write to us at hello@startuprock.com, and we would happily write you back and make you understand. Probably, if I can just take another minute, I'll just take you guys through it. This is our partner platform which we created for partners, where you can come in and track all your investments of your clients as well. So whenever there's a live option, I'm just showing you my dashboard as a partner, but for partners it's a little way more different than what it is. They can come in and they can add a client. Very, very simple for them to do it. And an automatic emailer for KYC goes to your customer for them to do it. Now, for certain people who you want to handhold them and do their KYC yourself, because many are ultra HNIs and they really want someone to handhold them, you will have the ability to do so as well through the platform by completing the KYC if you have all the data with them. And all the investments they make in future, you can track it very, very easily. For deals as well, very simple. Whenever there's an active deal, client invest as, because he can invest through his mother's, father's, whatever account. And whenever there's any live active deal, it'll be available for you. And whatever amount you want to invest, a deal gets created. Automatically, a DocuSign goes to your investor, CC to you for him to sign and transfer 10%. And as soon as he transfers 10, you get notified as well, so that you don't have to keep following up. Sir, did you transfer? Did you not transfer, etc. Collaterals, again, we understand if you want to share it to your investors in your logos, you're free to do so. You can just download it over here. The minute you do your KYC and upload your certificates and your logo, it automatically creates and you can do. So it's a very simple platform for them so that they can easily do their business and ensure they can track their investments as well, which real estate has never offered to the financial sector world.
And I can tell you, I mean, the wealth advisory fraternity is increasingly becoming interested in this kind of fractional real estate platforms. So, so I'm excited to listen to your talk. Thank you so much. And I wish you and the Strata team all the best for many, many more accomplishments going ahead. Thank you. So audience, that's about it for the day. I look forward to see you all tomorrow in the startup investment segment at 10 o'clock. Till then, take care. Good night.